Hello everyone. Today we're going to study about the asset liability solvency regulation, which I believe is the most important regulation in the entire IRDA or entire life actuarial. And all of the other regulation or guidance note or chapters that I have covered till now would be kind of summing up to this regulation. And usually when I read this regulation, I usually read this with the appointed actuary regulation. So what we'll do today is a portion, almost 75% of the regulation will be covered today, and the remaining 25% will be kind of read with the appointed actuary regulation. So you'll see how this regulation is important. So if you want to be the appointed actuary of an insurance company, then this is a must know regulation. And the regulation that I'm going to cover is based on obviously life insurance. It's not based on general insurance. General insurance have a different regulation, but if you want to be the appointed actuary of a life insurance, this is very important. Like, you can say that life insurance work can be divided into three predominant areas. One will be pricing, then there will be modeling, and then there will be valuation. Now pricing, the theoretical concept of pricing we read in ct 5 or cm1, chapter 12, profit testing. That is basically pricing, right? Then we study the concept of modeling in st2. And modelings are the person, or the modelers are the person who kind of has some knowledge about valuation, or right. Otherwise they cannot model. They have to kind of code things in profit or access based on the knowledge they have in valuation. And finally, it is valuation. So appointed actuary need, or the person who can become an appointed actuary, the eligibility criteria is to have some years of valuation experience even after qualification. So you will understand how important valuation is, and it's probably the most difficult portion because there is a lot of judgment involved. You cannot go wrong in say a modeling exercise, because this is what you have to achieve and you have to code it in this manner. But you can go wrong in a valuation exercise because there are a lot of judgment involved, a lot of decision making involved. And that's why if you have heard about that 1 crore package, that 1 crore package is given to appointed actuaries because of that reason, because of the decision making ability. So now this ALSM regulation is kind of divided into three parts. One is the valuation of asset, one is the valuation of liability, and other would be kind of dealing with the valuation of liability, but it would be dealing with linked business and non-linked business, and the final part would be dealing with the solvency margin regulation. So we'll try to cover the valuation of asset, and the valuation of asset has been kind of predominantly covered in preparation of financial statements and auditors report. That has been already covered by me. So if you have not seen that, I'll provide the link in the description so you can go and see that. But this would only involve a very small portion of the valuation of asset. This regulation is predominantly based on valuation of liabilities, and I mentioned in yesterday also that actuaries are the owners of liabilities. And I'll cover up to the liability section, and finally the linked business and the solvency margin section will be taken up tomorrow, along with the appointed actuary regulation. So that one can identify and see how important for appointed actuaries is to kind of know this regulation. So without further delay, valuation of asset. Now the following asset would be given a value of 0 in the balance sheet. That is intermediary or agents balance outstanding for a period more than 90 days to the effect that they are not realizable, similar, and that should be in India. And even if it is outside India, to the extent that it is not realizable, sundry debts or sundry debts, whatever you like to pronounce it, furniture, fixtures, stationary items. So you will not give any value to this asset, although these are asset. Deferred expenses, profit and loss appropriation account, any debit from the profit and loss appropriation account, and any debit from the profit and loss appropriation, any debit from the profit and loss appropriation account, and any fictitious asset other than prepaid expenses, service tax unutilized for a period of 90 days, reinsurance outstanding balance for a period of 90 days, leasehold premiums, and any other asset that is considered kind of inadmissible as per section 64.5 of the 64.5 of the Insurance Act. Now the assets are to be valued as per the other forms of capital which we are yet to cover, and preparation of financial statements, auditors report, that we have already covered, right? And the assets, the insurer is required to submit a statement of asset to the regulator, as per the form AA of the actual report and abstract regulation. The actual report and abstract is the way how the is kind of relates to the format in which everything is kind of presented to the regulator. So nothing much to read there, but I mean, one can go to that regulation and see the formats in which the reports are submitted to the regulator. So yeah, that's it. And then that will consist of the valuation of asset. Now, as I mentioned that I will be asking one question, and the person and I want to see that if someone can able to gauge the answer. So yesterday I asked a question that what do you mean by free capital with respect to a participating fund? The answer is estate. Estate is the free capital that is kind of used to support the asset share. So where we have kind of read about the free capital in the margins for adverse deviation, the condition was only in some extreme scenario where there is a closure of new business or the shareholder has to pump in money, then the 10% of the funds in the participating fund can be used to provide money. So that is the answer. Now here also my question would be, here you are seeing a point called debit balance of the profit and loss appropriation account and any other fictitious asset. So what do you mean by profit and loss appropriation account? That is the question. And if you know the answer to this question, please write it in the comment section. Anyways, moving to the valuation of liabilities. Now, valuation of liabilities is obviously because asset and liability, these are balance sheet items. So this will be calculated at a particular date, right? And since these are calculated at a particular date, so valuation of liabilities would be related to a valuation date. A valuation date means the date of investigation in which the actual investigation is kind of carried out. And policy account will see this in the linked portion section, linked product section, but policy account represent a segregated fund or earmarked funds for not segregated fund, it should be called earmarked funds for the variable linked business and variable non-linked business, right? Variable linked business and variable non-linked business. Now moving on to the valuation of liabilities. So the reserve would be, or the liability should be calculated, and in life insurance, reserve represent the liabilities. I think many people probably don't know this, although it is very simple to understand, but reserve represent the liabilities in the life insurance and in any other insurance as well. Reserve represent the liabilities, right? And here we are once again calling it mathematical reserve, right? Mathematical liability. So why we are calling this mathematical liability? Because I have already covered it in one of the earlier session that there is nothing like liability in insurance company. Liability is what we are kind of using probability and other modeling techniques to determine, and that we are calling as liability, and we are holding asset against those liability. But there is no physical existence of liability in the insurance company. We can mathematically say that there is a liability that might arise, but it doesn't, like it is not physically existing. So that's why this section is called determination of mathematical reserve, right? Mathematical word is very important because there is no physical existence in a, say for example, in a chocolate company there will be a liability, right? In a sports shoe manufacturing company there would be a liability because there the liability would be inventory. If you are not selling the inventory, then it would be like you would be losing money. So those are liabilities, but in this case there is no such thing as liability. Physical existence of liability is not existing because it's a insurance is based on service concept, right? Which is where IFRS 17 is also kind of based on that. IFRS 15 is actually based on service concept, and IFRS 17 kind of incorporates that service concept. Anyways, that is a matter of separate video and separate discussion. Let's moving on. So valuation of liabilities. So for each policy, the liabilities or the reserves will be determined using the prospective method of valuation. So we have studied CT5. There are two methods of valuation: retrospective and prospective. This is the prospective method of valuation using which we will calculate the value of the liabilities for each policy. Another method of valuation should consider the policy all prospective contingencies such as premiums which are expected to be paid by the policyholder and benefits which are expected to be paid to the policyholder, including any policyholder reasonable expectations, so including terminal bonuses. So that means we are also going to reserve for terminal bonuses. The method of valuation should also consider allowance for cost of guarantees, which is regarding GN22 or all the investment portion that we have studied, stochastic modeling, etc. So cost of guarantees should be kind of included in the reserves. then the reserve should also consist of margins for adverse deviation, which should depends on the confidence level of the expected experience, and that should result in increase in the reserve. This term increase in the reserve is very important. Also, the term that that will depend on the expected experience increase confidence level of the expected experience. Now, confidence level you can determine mathematically using a stochastic prediction. If you remember the maths that you've studied yesterday, that was related to, like, that was kind of calling for stochastic, using stochastic method instead of deterministic method. But we cannot use stochastic method everywhere because of the limitation of the computing power, or because of the way we kind of calculate it. That's why we use it only for economic variable. And now you can see everything kind of coming back together, right? Everything, every regulation guidance note is coming together in this regulation, right? So obviously the math should result in increase in the mathematical reserve. So then there would be the reserve calculated in this method might be zero, which we call negative reserve, or might be less than the surrender value, which we call surrender value deficiency reserves. Explanation: the surrender value here means the higher of the guaranteed surrender value or the special surrender value. What is the difference between guaranteed surrender value and the special surrender value? This will cover in something called non-participating product regulation, non-linked non-participating, non-linked product regulation, and linked product regulation. There will cover this. What is the difference between guaranteed surrender value and special surrender value? Now, coming back to this regulation, so the surrender value would be higher. Now the appointed actuary can calculate the mathematical reserve without making any mathematical modification to the reserve, and that would be as per section 35 of the act. However, the appointed actuary can also modify the reserve as per section 13, 49, 64.5 and 64.5a, and cause it to cause the reserve to limit to zero, which is called zeroization reserve, or cause it to be limited to the surrender value, so that the reserve would not be lower than the surrenders, so that the reserve would not be lower than the surrender value. Now, for 1 year group, 1 year renewable group term assurance business, the here prospective method cannot be applied, right? So that's why we'll use premium deficiency or unearned premium incurred but not reported claims. So you have already studied that. If you have studied ST1, you have studied this in ST1, right? And if there are, for individual policies, if there are riders associated, then the reserves would be higher of the gross premium valuation method or the unearned premium method. And for individual policies, the appointed actuary can also have incurred but not reported claims, because the reserve might be because the claims might be reported later than it has been incurred. Also, the appointed actuary can use any other method of valuation other than the prospective method if he or she thinks that it can be justified. However, the only criteria would be that the method of that the reserve produced by that method should be at least equal to the gross prospective method of valuation. And this entire methodology is called gross prospective method of valuation. The reserves that we are calculating, the method of calculation of the liabilities and assumptions should not be subject to arbitrary discontinuities from one year to the next. So, like, you cannot change the method of calculation or the assumption just on your whims and fancies, right? So that's what has been called out here. And moving on to the policy cash flows. Whenever we are considering policy cash flows, the next would be considering the assumptions, because you are projecting your cash flows in the future, right? To calculate the reserves, and you can only project your cash flows in the future if you have some assumptions. Right now, projecting, so that's why let's consider the policy cash flows, then we'll move on to the assumption and we'll stop there. Right, for today we'll stop there. So policy cash flows, the policy cash flows consist of expected future policy cash flows that will be discounted at an appropriate rate of discount rate. The policy cash flows will consider the expected premiums which are to be payable by the policyholder, the benefits payable on death, benefit payables on maturity, benefit payables on voluntary termination of the policy, which is surrender. And that would include basic benefits, rider benefits, bonuses vested at the valuation date. That is the bonuses which are already been declared, and future bonuses 1 year after the valuation date, including terminal bonus. We have already stated that the valuation methodology for India at least consider reserving for the terminal bonus, right? And then there will be commissions and bonuses which are paid to the distributors, and that should not include any allowance for commission for orphan policies. This is because of the prudent mechanism. If there is an orphan policy that there is no distributor, the distributor has probably left the life insurance company, then you are not supposed to pay commission, right? So you cannot take allowance for that. but in best estimate scenario, you can take allowance for that. So in this case, you cannot take because of the prudence concept. The maintain policy maintenance expense, obviously we know from the prospective reserve calculation formula, it is expected present value of benefit plus expense minus premium. And finally, the shareholder transfer, if there is a relation between the policyholder transfer, bonuses will be divided in a particular formula between the policyholder and the shareholder, provided tax allowance for tax has been considered. So this is for participating policies where there is a specific formula, it will be divided to 90:10. So when that should also be considered in the reserve. The policy options and guarantees, where policy provides options such as modality options like increase in the term or increase in the benefit, such that there is no movement, such that there is so no medical underwriting has been done, or without submitting any evidence for good health, or providing guarantees such as guarantee annuity options or financial guarantees. In such cases, they would be treated as special cash flows in the calculation of reserves. So we have not studied about model option, but we have studied about financial guarantees, right, in GN22 once again. So you can see that all of this regulation that we've studied till now is kind of coming back in sync and together in the ALSM regulation. Moving on to the valuation parameters. So valuation parameters would be the valuation parameters should be appropriate to the block of business being valued, and these are actually used to kind of project your expected cash flows to be discounted at a future date, right? So and that's why the valuation parameters should be based on the expected experience of the past experience of the insurers. If available, if the past experience is not available, then it should be dependent on the industry experience is available. If the industry experience is not available, it should be depends on the basis used for pricing. However, it should consider for any deterioration of the expected experience, a deterioration of the expectations, as for example for annuity products, the mortality rate will improve. So that should be any deterioration experience that should be taken into account. The expected level expected level of experience should be adjusted by MATs, and this MAT should be determined as per the APS 7 actual practice standard, which we have studied yesterday. And also the values used for valuation parameters should be consistent among themselves, like the inflation and the interest assumption, they should be consistent. The bonus scale and the valuation interest rate, they should be consistent among themselves. So it cannot be that the bonus scale is say 5% and the valuation interest rate is 22%. Doesn't make sense, right? So it cannot work like that. So now moving on to the mortality assumptions. The mortality assumptions will be determined based on the past experience of the insurers or the insurer's own experience, provided there is a published table which will be published by the Institute of Actuaries of India in concurrence with the authority, and provided there is and that table would only be used when the insurer do not have sufficient experience, right? So provided 100% of the mortality rates given in that table should be used by the appointed actuary, provided that the appointed actuary may decide not to use 100% of the mortality rates if the appointed actuary can justify. So similar consideration apply for morbidity rates. Exactly similar lines would be written for morbidity rates. Moving on to expense. So expense assumption will be based on the actual experience of the insurer. So, and it should increase in line with the inflation. The inflation should be consistent with the interest rate, as I mentioned, in the appropriateness of the consistency between the parameters. Now, if there should be additional provision that should be kept if the expense experience is not kind of based on the actual experience of the insurer. And in the first 5 years, there is no requirements of such additional provision that is required to be kept. But if when you are kind of new, everyone knows that you are kind of incurring extra expenditure. So in those 5 years, your reserve may not be based on expense experience. So that's why we see a expense overrun. We load the expense in the model with using a different assumption that will be my steady state assumption, and you expect that in future your expense would fall to this level. However, even after say 10 years of operation, if still your expenses are high, then you cannot use then you have to kind of use additional provision if you're using that steady state of expense. So that's why your expense assumption should be based on the actual expense. Finally, coming on to the valuation rate of interest, which is one of the most interesting thing. And when I was kind of a student, I was very interested in understanding how the valuation rate is determined. And trust me, there is no book where it is kind of given. Some say, like I mentioned in one of my sessions, that someone used to say that Market consistent value liabilities are discounted at risk-free rate. And I always wondered why it would be discounted at risk-free rate, why not at other rate, right? So there are different theories, but what I understand is market consistent valuation at discounted risk rate. That's because that is the only transparent rate available. Otherwise, everyone is going to use their own discount rate, right? So that's the reason. And then it is also reduced by, because market risk rate would be much lower, so the liabilities would be higher, and then it is reduced. But anyways, that is a concept that we'll study in embedded value. But coming back to the valuation rate of interest, now valuation rate of interest will be determined by the yields attributable to a particular block of business, existing yields, and also it will depend on the future yield. Like the if you have invested some money, the yields that you are going to get. So that would also determine that you have to also take into consideration, kind of to determine the yields that would be, or the interest rate that will be used for discounting. So it should be it should depends on the investment income generated by the existing block of business with regards to the expected income from the money or the sums that is invested for future. It should consider the investment expenses, expenses associated with the investment. For participating business, it should that the scale of bonuses should be consistent with the valuation rate of interest. For non-participating business, it should it should consider the decline in the interest rate. So that is where the derivatives comes into picture, the hedging. If you remember, the hedging, Indian companies can only hedge for interest rate, rupee interest rate derivatives, right? The derivatives that was used, and they can only hedge for non-participating business when there is a risk for reduction in the interest rate, right? Now the yield that would be determined would be cannot be higher than the yields that is generated by the block of business to which it has been attributed to. And also the future, that there would be a default risk associated, right? Because there might be a non-payment of investment income or the principal, and that would also have to be kind of taken into consideration for determining the valuation interest rate. Moving on to the lapse assumption. So lapse assumption, as we know, is dependent on the the sales channel, the distribution channel, target market. So lapse assumption once again be determined as per the past product or similar product experience, and it depends on the nature and the type of the product in future as well. So we'll consider the past, we'll consider the future, and we'll also consider the target market, distribution channel. And there might be other parameters depending on the type of business. However, those parameters shall be determined as per the schedule that is given in this regulation that we have studied. And if you studied the schedule, you know that we're following a prudent approach, right? So that would be followed. For the reinsurance, any reinsurance arrangement that involves that involves any form of borrowings like credit or deposit from the reinsurer without any prior approval of the authorities shall not be taken into consideration for the calculation of required solvency margin. And finally, if your reserve includes outgoes or inflows from reinsurer, then that would also follow the principles that can kind of been discussed in the regulation. And this regulation is also applicable for the balance sheet of the insurer, right? This regulation also applicable for the balance sheet of the insurer, and for balance sheet of the reinsurer. Basically, this for the books of the reinsurers. And as regards to the business ceded by the insurer, this schedules shall be applicable for the net sum at risk. For the insurer, which is kind of the net like you are going to use the net sum at risk to determine when there is a reinsurance. So you are going to determine the net reserves, and for net reserve you are going to consider the sum at risk. So I think we'll stop here. There are a lot of points that you've discussed today, and you can see that it is a culmination of all other points. And okay, along with that, maybe we can also finish the solvency margin section, which we have already covered. So solvency margin section is kind of determined by the form KT of ARA. So the basic thing that you can see here is so that is the form KT3. You can see this form KT3 of the actual report abstract regulation 2016 that covers the solvency margin regulation. Now solvency, in order to understand solvency margin, you have to kind of visualize in the following manner. Suppose you have total asset say of 150 rupees and you have total liabilities say of 100 rupees, right? So there would be 150 minus 50 would be your equity or would be your capital, right? So this 50 rupees would be the available capital, right? Now within that available capital there would be, you will require a required capital. which you'll always need to kind of keep that be a regulation against it. You cannot like put those required capital into equity, although that is free, that is not backing any liability, but you still have to kind of like maintain some regulation and restriction based on it. So how is that calculated in Indian scenario? It is calculated using factor based method. What are the factors? The factors are sum at risk and reserves. So it is you calculate using a percentage. So for reserve it would be, I think it is 3%, and for sum at risk it is 0.03%. So you multiply that and say suppose you get 30 rupees, right? So this regulation that is called that is called required solvency margin. So what this regulation states that your available capital, which was 50 rupees, and your required solvency margin, which is 30 rupees. So 50 by 30 should be greater than 150% or 1.5. 50 by 30 should be more than one. So in this case, obviously, 50 by 30 is coming out to be, I think, yeah, 50 by 30. Yeah, I think it is more than 1.5. So in this case, and it is that is the at least that amount has to be kept. So you are kind of keeping that money or more than that, right? So ideally, an insurer should provide like a few of the domestic insurers that I have worked with, they were used to target 300% instead of 150%. They used to target 300%, which shows that they are very well protected and they have very less chance of being insolvent. So yeah, those are the criteria. So I think this is already been covered by me in one of the guidelines. So that's the overall concept. There is a total asset, there is a liability, and this total asset liability may also be clear when you do analysis of surplus. But in any case, I think it's very simple to understand what is total asset, total liability. Total asset minus liability would be your available capital. Within that available capital, there would be a required capital, which is determined by factor, and that factor is a percentage of reserve and sum at risk. So say the available capital is 50, the required capital is 30, and then 50 by 30 should be more than 1.5, which is true in this case. Suppose what happens if the required capital is 60 and your available capital is 50, then the regulator might prevent you from writing new business, or may impose restrictions on you, or may force you to get merged with get acquired by some other insurer. That, I mean, that would mean that you have high chance of getting insolvent, right? So that's why regulator will come forward to kind of protect the policyholder interest. So there is only the section for linked and non-linked business that is left for ALSM regulation. I'll call this part 1, and the next part would be ALSM regulation part 2 along with the appointed actuary regulation. So if you like the content, if you are trying to, if you are kind of able to understand, because this is everything that you need to work in your day-to-day life. This is what you need to answer the why in the life insurance at least, and that will make you a good actuary, not a paper actuary basically. So if you understand all this and if you're liking it, please like, share, and subscribe. And if you don't understand something, if you want me to change something, then please provide your feedback in the comments. Thanks for watching, and see you in the future videos.